Next thing up, we're going to talk a little bit about standard deviation bands. I know we already covered a little bit about what a standard deviation is in the roadmap Q&A, but just a quick refresher. It is a unique unit of measurement that describes how far away a stock tends to get from its volume weighted average price, or from its average. That doesn't mean it can't go further than that. Quite to the contrary. You can actually see here we sold off aggressively at the start of the day. But what this is measuring is a typical or likely amount of violation or wiggle room around the volume weighted average price. And notice that these amounts of distance are equivalent. So one deviation up and one deviation down is the same. They are equidistant away from VWAP. The reason we like the standard deviations is because they give us additional support and resistance that is calculated rather than hand drawn onto the charts. It would be kind of foolish if we were to always try and draw in where we thought where we thought support and resistance was. It would make a lot more sense to be able to calculate it statistically such that we can then tell when a market is moving outward and away from its average in a kind of abnormal manner versus if we're just wobbling or being stuck kind of sideways around the volume weighted average price. You can see here again, fast lane behavior is very dramatically different from slow lane behavior. So I've drawn this big arrow to show that once we break up into the fast lane meaningfully, it really tends to lift off. Now, similarly, when a market downshifts from being, let's say, in the fast lane to reverting back into the slow lane, look at the difference in types of market between, whoops, that's not a very straight line. It's also not a very straight line, but we're going to stick with it. That'll be our divider between the two different types of market. It's almost like we have a trending phase and we have a counter trend phase. And notice that seems to change or shift when we get materially back up into the slow lane and decide we want to stay there. Not only does the slope kind of disappear during that phase as well, because remember, VWAP is flattening out and going sideways. But we're also observing those same characteristics of support here, and if we had made it up to this level, I imagine we would have seen resistance at the +1 deviation. So notice, like I was just saying about downshifting from having been in the fast lane and retreating back into the slow lane, look at how the market is content to go sideways, just lightly oscillating above VWAP, whereas during this entire prior zone, it was a very aggressive sell-off. Do you see the distinction here is that we have a strongly trending volume weighted average price and the market is repeatedly getting into the fast lane. So let's go back to Boeing. Clear these drawings as well. And you can see a pristine example of that kind of fast lane behavior here on today's charts. Now, it does get a little, I don't want to say sloppy, but a little messy early in the day. And that's why we don't tend to trade the first 30 minutes of the market. Tend to wait for it to pick a direction and then catch a kind of continuation trade if need be. Continuation is one of the names of the 4 basic trade types. It's something we haven't yet covered, but we're going to go over. Notice that there are multiple instances where we come to touch or nearby touch the deviation band while continuing lower and lower still. Now, eventually, there is a bit of a brief respite. We break back above the deviation band, but how long are we really there? Maybe 20 minutes, 30 minutes that we're above the deviation band before re-shifting back down into the fast lane. So notice that this is a vast majority of the day we spent in that fast lane to the downside. So here's another good example of, I'm going to turn on both. So we'll get the red-green colorization and we get the extra highlighting of the areas that we were in the fast lane. Standard deviation bands are curvilinear as well. What I mean by that is they're just a single line, but they curve and change. They're dynamic. They move throughout time to adjust with the market's newest behavior. I think what's fascinating about that is, of course, we've got that with moving averages, let's say, but nothing that really takes into account the entire day's volatility thus far to be able to gauge, well, is this normal or abnormal for this type of day? When you think about what VWAP enables you to do, you're really using a reference point, or an average in this case, that's calculated on the entirety of today's trading, not just the last 20 bars, not just something recent, but rather the entirety of the day. So it's more holistic than other technical analysis. That's kind of exciting because that makes you feel a little better that when a stock is breaking, let's say, out of its all-day typical volatility range, that's not just the last 20 bars. That's the last entirety of the day, however many bars you've experienced thus far. As I said before, we're kind of detecting support and resistance rather than discretionarily drawing it on the charts. Letting them curve and change throughout time according to an equation that we don't control kind of takes a lot of this out of our hands. But that should be very reassuring to you when we see or observe this kind of respect or behavior at the standard deviation bands, presenting multiple areas where we could participate back in that trade, even if we hadn't gotten a perfect short up near the beginning of the day. Some people have asked what is, one of my favorite things to trade, or how would I use standard deviation bands if I were just getting started? Something I often point out to traders is that when the deviation bands are moving relatively sideways and VWAP is moving relatively sideways, the likelihood of breakout is fairly low. But as a market or any chart pulls back to and rallies up from VWAP, and in fact, I got to point this out, actually pulls back to and rallies up from the deviation band itself, what's exciting to me is that we can see the deviation bands getting bigger, representing range expansion, price moving in a given direction. And when you hear that, and you hear me talk about price movement, what I'm really saying is if you're a trend trader, money to be made, right? There's opportunity there. So I tell traders, your job is not to trade during the tight or sideways deviation bands. And your job is not to trade when the market has already broken out necessarily. Your job is to try to target this in-between area where we are transitioning from a very flat VWAP to a sloping VWAP. I gave that a little too much slope, but for emphasis, right? You can see what I'm saying. If we trade too early, we run the risk of getting caught up in a sideways or choppy market. If we trade too late, we wait for confirmation, confirmation, confirmation. I think the problem with that is we end up taking a trade which requires a lot of risk just to get aboard something that has, how do I describe this? The odds in its favor, or the likelihood of continuation, because it's already broken out, it's already in the fast lane. So it's almost like I would like to see a VWAP and deviation bands that look like this, so relatively tame and sideways, but then it picks a direction and runs for a majority of the day. So what would price have to be doing in order to give us this kind of behavior? Maybe it's bouncing and finding some trend support. Yeah, something like this I think seems reasonable. But the key here is that as the deviation bands expand, looks a little goofy, I know, sorry guys. As the deviation bands expand throughout the day, our optimal point of time to trade is right when we're transitioning from counter trend or chop and into trend. If we trade too early, we're going to get stuck in a bunch of bullshit. If we trade too late, it's going to require a little too much risk in order for us to want to participate. Now, the key with this, you don't want to trade too early and you don't want to trade too late. So what are we really looking for at that tipping point? We're looking for a new definition of slope, meaning we're just starting to see slope start to perk up. And we also want to see the deviation bands start getting wider and further apart from one another. It's kind of hard to see the way I've drawn it, but you get what I'm referring to. Slope is going to mean that price is moving in a direction and trading with volume. Deviation bands expanding are further confirmation of the same. Channels are a fixed amount of distance at all times. They don't actually grow or shrink, if that makes sense. They're not going to be dynamic. So for example, if someone said, well, I'm going to set my distance measurement away from vwap to be $1 away from vwap, and it would always be $1 away from vwap. That would look very different than the kind of dynamic or expanding deviation bands that we see here as the volatility occurs later in the day. And so we want something that's dynamic, preferably, obviously. We want something that's going to grow or change with the market. So I think that's kind of like why do deviation bands matter, or like why can we trust in these? You know, I always go back to thinking about any dollar or percentage distance measurement away from VWAP, like the VWAP channels concept we were talking about. Is $1 away from the VWAP a meaningful amount of move away from the VWAP? Well, that can depend on the size of the stock you're dealing with. You might say, okay, well, you use percentage instead of dollars. And I would argue, well, but some stocks tend to move 5% every day. Some stocks don't tend to move more than 0.5%, right? So we can't use dollars and we can't use percentage in terms of a distance measurement away from that benchmark. We need something that's going to be statistically unique to that data set, to that chart. Something that's going to be kind of automatically calibrated, standardized, that's the right word, for that chart. In my mind, standard deviations are also, I mean, think about it. It's a common frame of reference that everyone can calculate. That's not susceptible to time frames. It's not idiosyncratic based on preference. Oh, you use $1 away from the VWAP, I use $2 or whatever. And it's standardizing volatility across very disparately sized stocks. So it's kind of like an apples to apples comparison, right? For what's typical or what's commonplace for two very different stocks. And the fact that it kind of automatically calibrates itself to give you a realm of what possibility of movement you're going to experience in that stock, that just makes it very convenient and intuitive. All right, guys, I want everyone to put their pun hard hats on. I'm going to use a really, really dumb joke here, okay? So when we think about why not wait for a pullback to the VWAP, and we say, well, it might not pull back to the VWAP, I describe the market as a game not of musical chairs, but of musical shares. And I know everybody just died a little bit hearing that joke. The point being, there's a limited amount of supply available for every stock. And so in the event you are in a strong uptrend, people are buying aggressively. Are we going to anticipate waiting for a pullback to the VWAP? Are we going to be so greedy as to wait for a move down into the lower fast lane before we buy? And the answer is probably not. We as institutional traders, let's say, let's just pick a random spot on the chart, somewhere like right in here. Let's say we've seen the market trading upwards. People are clearly bullish on the stock. It reported good earnings. It gapped up. It traded higher. Slope is decent, etc. If we don't buy it at the deviation band and we instead wait for a pullback towards the VWAP, well, the problem is, what are we going to feel like at the end of the day? If we didn't fill our order entirely, if we didn't chase at the deviation band, thinking it might pull back to the VWAP, well, we're going to miss out on, what is that, nearly 5%, 4% on the stock for the remainder of the day. What is a heightened deviation band at 10:30 in the morning or something might look like a real discount by the end of the day.